Welcome. My name is Stephanie Cole Brock. I'm going to be doing a thorough business analysis on publicly traded military contractors. Some of the biggest military contractors are United Technologies Corporation, Raytheon Company, Lockheed Martin Corporation, Northrop Grumman Corporation, General Dynamics Corporation. Before we go any farther, it is helpful to know what exactly these companies do to get a better understanding of their cash flows and the way they do business and the products that they sell. First, United Technologies Corporation is a research and development company. They also manufacture products like aircraft engines, aerospace systems, HVAC, elevators and escalators, fire and security systems, building systems, and industrial products. The second company we will cover, and you will hear a lot, is Raytheon Company. They are a major U.S. defense contractor and industrial corporation with core manufacturing concentrations in weapons and military and commercial electronics. The third company you'll hear a lot in this video is Lockheed Martin. They operate in 4 business segments, including aeronautics, missiles and fire control, rotary and mission systems, and space systems. The fourth company is going to be Northrop Grumman Corporation. They are an American global aerospace and defense technology company focused on products like military crafts, military vessels, missile defense systems, as well as satellites. And lastly, General Dynamics Corporation. They are an American aerospace and defense multinational corporation whose products include business jets, combat vehicles, fighter jets, weapon systems, and watercraft. Now that we're familiar with the background of these companies, we can move into the main focus of this multi-company analysis. I'll be using multiple financial ratios to analyze those companies that we just went over. To do so, I'll be covering short-term, long-term solvencies, asset management, profitability ratios, as well as market value ratios. So here's the big question. What is any of that? Well, a short-term solvency is also referred to as liquidity measures. This is a key metric used to measure an enterprise's ability to meet its debt and other obligations. The solvency ratio measures an enterprise's ability to meet its debt and other obligations. The solvency ratio indicates whether a company's cash flow is sufficient to meet its short-term liabilities. To figure out the solvency of a company, ratios such as current, quick, and cash are performed to give an estimate of the company and if they can pay their short-term bills. So on this next screen, I compared our 5 military defense companies from the beginning over a course of 5 years. Current ratio is computed by dividing assets by liabilities. Throughout this PowerPoint, you'll be able to see on this top right-hand corner will be the equations for each one of the ratios that I'll be computing. Now, when comparing current ratio, you want it to be as high as possible in order to pay short-term creditors. However, if it's too high, as you can see here in 2017, compared to all of the rest, with Northrop Grumman, the firm may be insufficient with cash and other short-term assets being that high compared to the rest of the industry. Now, let's pretend that based solely on this ratio analysis that I'm a banker and all of these 5 companies have applied with me to take out a loan. Based strictly on this information, I can only say approve 2 loans. Who should I grant the loan to? How would I know? Well, personally, I wouldn't take into consideration Lockheed Martin Corporation every year they have the lowest capabilities of paying me back. As you can see, starting in 2013, 14, 15, and 16, and even in 17, compared to the rest, they're still below average from what everyone else is even capable of doing. Now, Raytheon, obviously would be my first choice to grant a loan to, based on having the highest current ratio year after year. And my second company is actually kind of tied. Even though Northrop is clearly really high in 2017, it however also concerns me. They may have too much assets just sitting around. This doesn't mean that it's just cash that's sitting in a bank waiting to pay me. If this was the case, they wouldn't be requesting the loan. And also, it could be that they're sitting on old inventory that's obsolete, that they are counting as an asset, or someone understated their liabilities. But there must be something wrong. This is very concerning to me. But since this is a recent drastic growth in the past year, it makes me kind of uncertain as well. So therefore, I'd have to go with General Dynamics as my other company that I would have to give a loan to, as well as Raytheon. Now, quick ratio is another way to look at a company's short-term solvency. Once again, in our upper right-hand corner is our equation, our current assets less our inventory divided by our current liabilities. And in a quick ratio, the quick ratio measures the dollar amount of liquid assets available for each dollar of current liabilities. Thus, a quick ratio of 1.35, here is seen in 2013 from Northrop Grumman, means that the company has $1.35 of liquid assets available to cover each $1 of current liabilities. Good quick ratio is anything that's about greater than 1. Now, going back to our question from current ratio, of pretending that based solely on this ratio analysis, I'm once again a banker, and all 5 of these companies have applied for a loan with me. Based strictly on this information, I can approve only 2 of those loans. Who should I grant the loans to? Well, this analysis is much easier. It lets us know now that the large group of current assets in 2017 were not inventory, helping to result in choosing Northrop Grumman this time and Lockheed Martin, since every year they continue to have a higher number compared to their other companies. So our last short-term solvency ratio is cash ratios. Cash ratios is the ratio of a company's total cash and cash equivalences to its current liabilities. Our equation for cash ratio is our cash divided by the liabilities. Now, this can be tricky to decipher if a high cash ratio is good or bad. Having a high cash ratio would mean that the company has a lot of cash just sitting around, not being used. This is actually not good for the companies. Now, once again, going back to our question, from the current ratio of pretending that based solely on these ratio analysis, that I am once again a banker. And all 5 of these companies have applied for a loan with me. Based strictly on the information provided on this screen, I can approve only 2 of those loans. Who should I grant the loans to? I personally would base strictly on this information. It's pretty clear to see that Raytheon and Northrop have the cash available to pay me back for my cash flows that I'm investing into them. As you can see here, Northrop every year is clearly leading their competition, and Raytheon is coming in either above them at some times or right below them at others. As seen here in 2017, they're a little bit below, but that doesn't make a difference. The 2 that I would choose would definitely be Raytheon and Northrop Grumman, based on their cash ratios. Now, on this slide, it may seem like a lot's going on, but all I've simply done is combined all of our ratios in one location so we can easily analyze them. I have our current ratio, quick ratio, as well as our cash ratio that we just went over. And we're going to now analyze our short-term solvency as a whole for all 5 of our companies to truly see which 2 we should choose to give that bank loan to. In my current ratio, I had chose Raytheon and General Dynamics, as you can see here, Raytheon and General Dynamics. And in our quick ratio, I had chose Northrop Grumman and Lockheed Martin, which are right here and here. And in my cash ratio analysis, I had chose Raytheon and Northrop, which are seen here and here. Now, I would conclude that Northrop Group, and they have a lot of inventory on hand as well as good cash flows in correlation to liabilities. So ultimately, in short-term small investment loan, I would grant them and Raytheon Company the loan based on the availability of current assets to liabilities. The next unit we're going to go into is long-term solvency. Long-term solvency ratios is a key metric unit to measure an enterprise's ability to meet its debt and obligations. The solvency ratio indicates whether a company's cash flow is sufficient to meet its short-term as well as its long-term liabilities. To figure out the long-term solvency of a company, ratios such as total debt ratio times interest earned and asset turnover are performed to give an estimate of a company's ability to meet its financial leverages. Now, things to keep in mind during this analysis: with increased debt comes greater risk as well as higher potential return though. On this next screen, I compared once again our 5 military defense companies from the beginning over a course of 5 years. However, this time, the focus is on long-term solvency. One of the long-term solvencies are total debt ratio, as seen in our graph. Hypothetically, if these companies wanted to take a 5-year loan from me, once again, I'm the banker, which 2 would I choose based on the amount of debt to assets they have? Now, a debt to assets is calculated once again here in the upper left-hand corner as the current liabilities plus long-term debt divided by total assets. Now, remember, my goal is to get my money back as the banker. Clearly, based on the numbers that were provided, Lockheed Martin has way too much debt that they could even take into consideration of being able to take care of. I'm going to go with Raytheon and General Dynamics on this one. They have the lowest of the debt to asset ratios. I think this is very important, and keep this in mind for future slides. This is very important. This is going to weigh heavily on a lot of my decisions farther on with other ratios. Our next slide is times interest earned ratio. This is another way to look at companies' long-term solvencies. In a times interest earned, we want it as high as possible. The higher the ratio, the better able the firm is to fulfill its interest obligations. Now, EBIT, which you can see here on the top right-hand corner, in our equation to find times interest earned ratio divided by interest, is the same as our operating profit. Now, to analyze our data that was provided, going back to our question from total debt ratio of pretending that based solely on this ratio analysis that I'm once again a banker and all 5 of these companies have applied to me to request a loan. Now, without question, it's obvious who the first choice would be for that 5-year loan. General Dynamics. They are clearly leading the way compared to their competition. Now, the second may not be easily to spot, but United Technologies is below 10 for the past 5 years, so we can easily eliminate them, which leaves us with Raytheon, Lockheed Martin, and Northrop. Since I'm giving out the loan today, I'll rely on statistics strictly from 2017. And also keeping into consideration a consistency in a particular company. Therefore, I'll issue my 5-year loan to General Dynamics and Raytheon. Now, to our next slide. Asset turnover ratio is the second of 3 ways to analyze a company's long-term solvency. In asset turnover, the higher the ratio, the better. This indicates the efficiency with which the firm uses its assets to generate sales. This means that they are not holding onto inventory that can't sell. Once they receive it, they're shipping it out just as fast. Therefore, as you can see here on the upper right-hand corner, we have our equation once again for sales divided by our total assets, which gives us that asset turnover ratio. Now, to analyze our data that was provided, who would I choose to approve a 5-year loan to? Well, based strictly on our current graph, we can see that Lockheed Martin is moving assets just as fast as they are receiving them. Now, choosing a second candidate gets pretty tough here since they all have around the same turnover rate. I will have to go with General Dynamics as my other applicant. Northrop and Raytheon came pretty close, and I would be higher 1 year than the other, but then as you can see they switch out. So I'm gonna have to go with General Dynamics as my second company, but they barely made the cut. And here we are again with all of my long-term solvencies, and let's analyze them now as a whole for all 5 companies for all 5 years. Now, to truly see which 2 we should choose to give that 5-year bank loan to, we're going to have to recap. In my total debt ratio, I had chose Raytheon and General Dynamics. Raytheon is here in the gold, and General Dynamics is here in red. And our solvency times interest earned ratio, we had chose Raytheon and General Dynamics. Once again, Raytheon and General Dynamics. Starting to see a pattern here. Wonder who I'll choose. Now, in my asset turnover ratio, we had chose Lockheed Martin and General Dynamics, as seen here, as well as here. Now, seeing all the subcategories of long-term solvency laid out, I would conclude that Raytheon and General Dynamics would be my final choice for long-term solvency loans for those 5 years. Our next unit is profitabilities. Net profit margin is the percent of revenue remaining after all operating expenses, interest, taxes, and preferred stock dividends, but not common stock dividends, have been deducted from a company's total revenue. To figure out a company's profitability, net profit margin ratios are performed. Profitability is measured using net profit margin ratio by taking a company's income divided by sales, as seen in our top right-hand corner as usual, where our equations are. Net profit margin, though, is a little tricky when deciphering if it's good or bad. A net profit margin for large priced aircrafts and military issued equipment wouldn't be unusual for as high as 10%, but they aren't selling as many compared to a grocery store who should be closer to 1%. Ultimately, the higher the better. Here we are, analysis time. So the big question for this video is to grant 2 loans based on the ratio of 5 military-based companies. So which is it? Here, I'd have to go with General Dynamics, and both Northrop and Raytheon draw a close second place. We definitely wouldn't want to go with Lockheed Martin on this one. You can see that in 2017, profitability wasn't so well for them. Who's it gonna be then? Well, Raytheon continues to be over 8 every year by just a few. As you can see, let's draw our line. Well, that's not very much straight line. And it's kind of crooked. But we can conclude that Raytheon would be my other option to choose from. The last unit we're going to go over is the market value ratios. They are used to evaluate current share prices of publicly held company stock. These ratios are employed by current and potential investors to determine whether a company's shares are overpriced or underpriced. The most common market value ratios are as followed: PE ratios, market to book, return on equity. Market value of a company is measured by using price earnings ratio. By taking the market price per share of common stock and dividing it by earnings per share, as seen here in our equation corner. High PE ratios tells us that firms have significant growth opportunities. The higher the PE ratio, the greater the investor confidence. So this time during my analysis, I'm going to change it up a little bit. Instead of choosing for a loan, I'll be comparing based on if I want to actually invest into 2 of these 5 military-based companies. So here we go. So in 2017, it must have been a good year for these companies. All of them went up compared to the leading 5 years. So clearly, we are to choose from Raytheon and Lockheed and Northrop. However, based on what we went over in our short-term and long-term liquidity analysis, Lockheed Martin's having some cash flow problems. Yet the market sees them as doing quite well. They may be fooling the investors, but they're not fooling me or pulling wool over my eyes. So for investment purposes only, I'd have to go with Raytheon and Northrop. In our second most common used measurement of evaluating market value of a company, it is market to book ratio. Market to book ratio is calculated by dividing market value per share divided by the book value per share, as once again seen here in our equation corner. We want a high market to book value. This helps us find the value of a company by comparing the book value of a firm to its market value. Book value is created by looking at the firm's historical costs or accounting value. So if we take a moment to analyze some of this, the numbers that are being analyzed was already provided. Therefore, if these numbers are in fact correct, it would seem to be clear as to who is worth more in the marketplace than on books, which obviously is Lockheed Martin. Oh, my mouse got stuck, excuse me. However, I'm feeling very biased on these statistics, knowing that Lockheed Martin is having some cash flow issues and was down in sales last year based on our short-term and long-term analysis that we had performed. I'm led to believe that their number is in fact correct, possibly, meaning that the market doesn't really know their hardship that they may be currently going through compared to other businesses in their field. And with that being said, on this one, I'd have to choose Northrop and General Dynamics to invest into. And our last analysis on market value is to use return on equity ratios, which is a measure of profitability that calculates how many dollars of profit a company generates with each dollar of shareholders' equity. The formula for net income divided by shareholders' equity, which is the same equivalence as market price per share of common stock divided by earnings per share. Now, a high ROE suggests that a company is increasing its ability to generate profit without needing as much capital. However, a high level of doubt can artificially boost the return on equity, after all, because the more debt a company accumulates, the less shareholders' equity it has, which can boost that ROE. Now, what do we have here? It looks like my questioning mind on Lockheed is starting to be more supportive. I believe that they have more debt than they could handle, and as a result, it's getting such drastic numbers, which makes this choice a little easier. I'm going to go with Northrop and General Dynamics. It seems to be averaging about the same year after year, which makes me feel a little bit more comfortable. So here we are again, with all of my analysis on one screen. But what does this mean? Why individually look at each section of the market value of a company? Well, it helps to decipher which companies I should truly invest my money in. Putting them side by side and comparing them helps me analyze this. Now, let's do a recap of the previous three ratios that we had done. Price earnings ratios, we had chose Raytheon and Northrop. Raytheon is here in gold, and Northrop is here in yellow. And for our market to book ratio, we had chose Northrop and General Dynamics. Northrop. And General Dynamics. And lastly, we had price earnings ratio, which was Northrop and General Dynamics. Again, Northrop and General Dynamics. Now, without a doubt, I would have to conclude that my final investment, based on market values, would be a tie between Northrop and General Dynamics. Yet, if I had to choose just one, it would have to be Northrop. Between their liquidity and equity, their liabilities are low, and they are moving inventory quite fast through the company. Everything to me that says my money is well invested, as well as a secure, probable return. The risk for this company is low since they are more financially stable. Therefore, I wouldn't expect a large return on my investment, but that's just fine for me. Lower risk satisfies me more. Now, to conclude, recap of today. We covered short-term solvencies, long-term solvencies, asset management, profitability ratios, market value ratios, and how to calculate and analyze this data individually as a whole. Now, disclaimer, I hope you enjoyed this video. I am not responsible for any misconceptions of telling you how to or where to invest your money. This is based solely on me and where I would invest my money based on my interpretations of the data that was provided to me.